Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard, and happy spring.
Yes, the first day of spring. It's always nice to be on the show.
And, of course, in Edmonton, they're, predicting more snow?
I guess, the snow is still here, but it's melting. So there's hope. Some of the streets are actually bare, so we can see pavement for the first time in 4 months or so. And
in the Vancouver area, we're expecting a few snow flurries in a day or two.
Yeah, that's hard to imagine.
But, yeah, everything's green in Vancouver the way it usually is all winter. Hilliard, we do have something very interesting to talk about. The Bank of International Settlements in Switzerland has put a bunch of different colored flags up for Canada, 4 different colors, 2 red, 2 yellow. What's going on here?
Well, this is the continuation of something that's been going on for some time, but this is the first time. And as far as I know, and I can't, I didn't have time to check this before we talked, but as far as I'm guessing that this is the first time that any country has ever been flagged on all 4 indicators. So they've got these different measures. Now, first of all, I should say the Bank for International Settlements was founded by 30 central banks around the world. So Bank of Canada, Federal Reserve, Bank of England, they all got together and they kind of all report to the Bank for International Settlements. And the thing that allows the BIS, as it's known to do, is to gather all the data from all the different countries, and then they compare it. So every quarter they put out this thing, and this quarter, and this has happened before, in the last 3 years, they've mentioned Canada several times. They have these 4 measures, and there was 3 countries, Canada, China, and then I guess Hong Kong is a region rather than a country, but those 3 were singled out for mention. But of those 3, as being at risk of a financial crisis due to too much debt. But of those 3, Canada was the only one that was at risk on all 4. And now 2 of them are the credit to GDP gap. So the credit to GDP means how much new debt are you putting into the economy in order to get the growth in the GDP that you're getting. And once the gap gets above a certain benchmark level, they consider that dangerous because you're not getting you're not getting as much bang for your buck. You're going deeper into debt with less to show for it. The second one is overall credit, so household credit and everything else, corporate debt, government debt, I guess, too. The third one is household debt, and Canada's always been warned on that one because we've got one of the highest household debt ratios in the world. And then the first one is called debt service ratio, so the debt service ratio, so how much is your debt costing you? And that's actually a new one for Canada because our interest rates were so low up until recently. They've been rising. Even though we were going deeper and deeper into debt, we could afford it. And, in the short term anyway, allegedly we could afford it. My thesis, of course, is that we can't afford it, but it looked like we could afford it because the interest payments were still low even though we had a bunch more debt. So 2 of them are red and 2 of them are yellow, and this is as far as I know, the first time any country's ever been singled out for all 4. Now, there are other people besides the BIS saying the same thing. Professor Steve Keen in England is singling out Canada and 6 other countries as being at the risk of financial crisis, and I've written about that a few times in the past. So, but this is the first time we've been singled out with all 4 indicators flashing an alert. It's called the early warning indicators, is the term they use.
Well, should we be ready to what? What should we do? Should we be panicking or what? What do you do when you have 4 indicators claiming you're due for a financial crisis?
Well, if you're an economist that works for one of the major banks, what you do is, and this came out. So this is interesting because generally the economists ignore this stuff because, as you and I have discussed in the past, economic models do not consider debt and banking and money and all that as important. They look at other things like productivity and inflation and all that stuff, but they don't actually look at this stuff. But this was such a this warning got quite a bit of attention. So it provoked a reaction from the chief economist for CIBC. His name is Avery Schenfeld. And he said that this warning is false because he had a couple of reasons. One is there's been very few foreclosures. They call them arrears, mortgage arrears, which is actually an early warning indicator for foreclosures. People start falling behind on their mortgage payments. And the other one is that interest rates are so low, again, going back to that thing that people could afford the debt. But I think he's wrong. I think that the fact that he's working for one of the companies that is one of the lenders that's most heavily exposed to the household debt sector is probably influencing his view. But I think he's wrong. I think the warning is because the warning actually did include the debt service ratio. So even at these record low interest rates, or they're not record low anymore, but these currently still quite low interest rates, the BIS felt the warning was due. But the thing is, the other thing we heard today was the Federal Reserve has raised rates again today, and they're predicting 3 more increases this year and several more increases next year. So we're not going to enjoy these low interest rates for very long. And when the debt has basically doubled and tripled in the last 15 years, even a small increase in interest rates, and the Bank of Canada's warned about this, is going to have a big impact. And we've just never been through this before in Canada. So we should be panicking. So as a country, we can't really panic. As individuals, we can panic. And as a country, we can't really fix this in any short period of time. It would take a long time to fix it. But as individuals, we can fix it. Each individual household has the ability to fix their debt problem on their own, is assuming they're not too deeply into debt. But even then, they can fix it by going bankrupt. But lots of people could fix their debt problem by not, taking on that big mortgage and buying that big house, or if they have too much debt, selling that property and paying off the debt. And but collectively, as all of us together, if we all tried to do that at the same time, it wouldn't work, because what would happen is we'd all put our houses on the market for sale, and the house prices would drop so much that we wouldn't be able to pay back our debt by selling them, because we wouldn't get enough. We wouldn't get a good enough price for the house to pay down the debt. So it's one of those things. There's just no. We're just going to have to work through this as a country and as a group of Canadians. And what puzzles me is how we went from being these prudent, debt-averse Canadians to being the country in the world that has been flagged as basically the worst offender when it comes to debt.
We'll have more with Hilliard Macbeth right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, given these credit warning signs, what could a person be doing right now? Just stop using your credit card, start paying down your debt. And I also saw a report where it said Canada's debt to GDP ratio had actually gone down a bit. The first time that's happened in several years.
So the there's several things. There's a debt to GDP ratio in terms of incomes and household income and household debt. And then there's government debt. So actually, the good news in Canada is that the government debt to GDP ratio, the federal government anyway, is in really good shape. So if the U.S. is at 80% debt to GDP ratio and the government, after they went through their crisis, Canada's still at 33%. So we're less than half as indebted at the federal government level as the U.S. is now. The U.S. was similar to us prior to 2008 when their crisis hit. But they had to take on a lot of debt to bail out the big Wall Street banks and other things that they did. They bailed out GM and Chrysler and a bunch of other stuff, AIG, and so the government ended up much, much more deeply into debt. But in Canada, the debt level for the government is actually quite reasonable at the federal level. The picture is not quite as rosy as that sounds because, for instance, Ontario is one of the most heavily indebted entities in the world. If it were a country, it would be very high on the list of, it's got over 320 billion Canadian dollars in debt, which is a pretty high debt to GDP ratio. So if you're sitting in Ontario, if you're a Toronto person, you got the debt of the city of Toronto, you got the debt of the province of Ontario, you got the debt of the government of Canada, then you got the debt of your household, and it's a pretty heavy burden to carry just for one little household to pay all that debt. So obviously they can't pay it all back. So, but in the household segment, to narrow in what you're asking, it is still extremely high. There was a slight downtick recently from 170.5 to 170.4, but it's really nothing, and that number is so much higher than it was in 2008, and so much higher than the U.S. was in 2008. It's still very dangerous. So, the individual household has the opportunity to do something about it, and I would recommend that they take that opportunity to lower their debt if they possibly can, and even if it means selling assets in order to pay back the debt.
If the U.S. is going to raise interest rates several times over the next couple of years, is the Bank of Canada forced to do the same thing? So
that's a very good question. And so right now, interest rates in the U.S. are actually higher than the interest rates in Canada, whether you look at the 2-year, the 5-year, the 10-year, or the 30-year rate. And the Bank of Canada raises the rate slowly, and the U.S. Federal Reserve raises the rate rapidly. If our interest rates were to stay a lot lower than the U.S. As this cycle progresses, what would happen would be the Canadian dollar would start to fall. So it's already fallen from 82 cents in September down to about 77 cents. It hit 76 cents briefly a couple of days ago, and it's up to 77 cents today. But if our interest rates stayed a lot lower than, if we don't match, let's say, let's put it the other way, if we don't match the increases that the U.S. is going through, then our dollar will slip even further. Because if you can get, right now you can get 2.3% on a 2-year bond in the U.S. and you know they're going to raise rates. They've announced it. So the U.S. dollar is likely to be strong as well. Or you could take less than that in Canadian dollar and you figure the Canadian dollar is going to be weak. Why would you do that? It doesn't make any sense. You got lower interest rates and plus you got a loss on the currency. So a lot of this money is sort of international hot money that moves around wherever the best rate is and wherever the best prospects for the currency is. And we would have a terrible time that way. So if we also get into a housing crisis at the same time, then the dollar would be even weaker because then people would view Canada as, right now they view Canada still pretty positively. We still have our AAA credit rating at the federal government level. And so they're willing to accept a slightly lower interest rate than the U.S. at the moment, but that won't last long if we get into a housing crisis. When they start adding up all those different government debts, what can we do about that when each government says, oh, well, it's affordable for us, but they don't take the accumulated total into effect? So obviously the Ontario government, so you imagine a scenario where there's a crisis in Canada like the U.S. had 9 years ago. There's no way the federal government can walk away from the Ontario government. So basically it's all the same, right? It's, the obligations are, and the same with Quebec government, which has a smaller debt than the Ontario government, but it's not a lot smaller. And of course the population is quite a bit smaller in Quebec than it is in Ontario. So, BC is one of the few provinces that actually is running a surplus and is got its debt under control. And Alberta used to have a very good situation where Alberta didn't have any debt, but lately Alberta's been rapidly going into debt as a result of the downturn in the oil price. So the combination of all that is basically it would be impossible to pay back that government debt. And actually, what would happen in a downturn related to the real estate sector would be that the government would have to go deeper into debt, and it could either do that voluntarily or involuntarily. It doesn't matter. It would happen in any case, because they would have to bail out CMHC, which has very few actually. Depending on how you look at it, they've got zero reserves, or they got $30 billion in reserves, but basically they don't have enough to back all of the insurance claims that they would get hit with. And conceivably, they also might have to help the Canadian banks if the housing correction turns into a severe correction. So the government wouldn't have any choice. The government, is running a deficit now, and most provincial governments are running a deficit as well. And that money, that even an attempt to pay that back would create a recession. So it's really not going to work. And so the next couple of years is more likely to be the government trying to help the private sector get through the whatever it is that's coming down the pipe related to real estate. And then after that, maybe have a look at trying to balance the budget. But unfortunately, any attempt to do that now would be futile.
Well, right now BC has a law that makes it illegal for a municipality to have a deficit. Do other provinces have that law?
I remember Ralph Klein passed a law that said we can't run a deficit in Alberta, and that was in 1993 or 4 or something like that. And they basically ran a surplus for a couple of years, and then they went into deficit again. Of course, that law can be changed so easily. It's now municipalities, though, is different because, of course, they are creatures of the provincial government, so they don't want municipalities running around going into debt, and that actually makes sense. So in Alberta, they have the Alberta Municipal Finance Corp, and municipalities and airports and other entities like that are able to borrow using the Alberta government credit rating. And that's what they do. But it still is, the city of Edmonton's got $2 or $3 billion in debt. The city of Calgary's got even more debt. So it's, they can pass all the laws they want, but, if you got to have that rapid transit thing built, or if you got to have that something else, then basically people just go ahead and do it and worry about paying for it later. Like we're all doing that now. Governments and individuals and households we all have that same mentality. We want it now, we'll do it now, and then later on we'll decide to pay for it.
We'll have more with Hilliard Macbeth right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Hilliard Macbeth. Hilliard, are people still concerned about BC's speculation tax? We don't know how that tax on empty real estate or second homes will be brought into force, but so many people in Vancouver have cabins in the interior. So many people in Alberta have recreational property in BC. Is it still causing a lot of concern?
I think it is. I think more so in Alberta than in BC even, but obviously it applies to a lot of different people. And I think some surprises. I think the government probably is a little bit didn't anticipate all of the uproar that has been triggered by the announcement. And I know that they said that the rules will actually be coming later, and so later is probably pretty soon because it's been a month now, I think, approximately. So But the thing is, I was thinking about this though, and I thought, well, and I don't know if this is right or not, but this is just a thought, and that is, how easy would it be really to get a relative or somebody to say, okay, we'll sign a lease, because the rules are going to say if it's leased for a year or whatever the long term, I don't know what the definition of long term will end up being, but that's the rule. You can avoid this tax if you got somebody signing a lease. So sign a lease, maybe a daughter or a son or a cousin or something, and have them move in a few pieces of clothing or something, and even if they don't live there, at least the thing is leased out, and you avoid the tax that way. So that they're going to have to, so that means that compliance is, forcing compliance is going to be very difficult. But Albertans are that's harder for Albertans to do that because they don't live in BC. It'll be easier for BC people to do that. And maybe there'll be a lot of places put up for lease, and somebody can get a really nice rental at a cheap rate just to help an Albertan avoid the tax. So on a $500,000 cabin or something, that's, what is that, $10,000 a year? That's almost $1,000 a month. So to avoid that, you'd be better off to lease it to somebody. Even if you only got $500 a month from them, you'd be way better off, and you save $1,000 a month in tax. So I don't know if they're going to rethink it or what they're going to do. I have heard from various people that are convinced that the government's going to back down on this. But I don't know. We're going to find out, I guess. It's a government that is pretty new, and on the other side of it, the polls, apparently, the opinion polls are showing that 80 to 90% of Vancouver people agree with the tax. So they may not back down. Albertans don't vote, so it's in BC, I mean. So they can have outraged Albertans, I guess, and still survive the next election. So,
now, would this tax just be a tax grab, or would it have any effect on the affordability of homes?
I think it could actually cause, if somebody was on the edge and they're sitting with this empty place and prices are no longer rising in a lot of areas in BC now. And I know the condo market in Vancouver is still hot, and Whistler's still pretty hot, but West Van, North Van, single family homes have basically been flat or prices are dropping for quite a while now. So there's a very large inventory of single family homes for sale in the higher priced end of it anyway. So if somebody's on the edge and they thought prices would be rising forever, but now they see that the prices are flattening or maybe could come down, it might just cause them to sell, because rather than have the hassle of doing this tax and putting a renter in there that you don't know, and they could wreck the place and stuff and you're not going to get the rent that you really, if you got $2 million tied up, or even $1 million or $500,000 tied up, your rent's never going to cover your costs of owning that place. So it would be better just to sell it, and that would be the easiest way to avoid the tax if you're not going to use it. So I think there might be some of that. I think, depending on how many people were speculating on BC real estate and how, if their view changes, because the view is up till now been pretty widespread that prices always go up. So I don't know that people have actually opened up the possibility in their minds that prices could actually drop. But if they started to do that, if they started to think that prices could actually drop, then there would be two reasons to sell, then a speculation tax plus the chance of the prices might be lower a year or two from now.
In situations like this, like you said, in the past, we haven't seen it. Do you think people in Vancouver are still relying on the fact that in any given year, anywhere from 25 to 40,000 people move here, so there's always going to be pressure on real estate?
Well, that's the story that, one of the things about bubbles is that people keep passing these stories around and they're just not correct. So there's always people moving to certain places, and one of the things that is unusual about Vancouver is that people hate leaving Vancouver. Once they're there, they'll accept a job with a lower pay, and they'll live with the housing difficulties. But the biggest influx of people, much bigger than Vancouver on a percentage basis, because we know from the census that came out in 2016. Was not Vancouver or Toronto, it was Edmonton and Calgary, and the increases in Edmonton and Calgary over the 5-year period were 2.5% roughly, slightly higher in Calgary, slightly lower in Edmonton per year. And house prices were flat to lower. So in Edmonton, and they now are roughly the same in Calgary after the drop as what they were 5 or 10 years ago. So all of those people moving there did not guarantee that prices would go up. So, and now in Toronto and Vancouver, the increases in population were more in the 1 to 1.5% range, which is just normal. So you can't use that argument. Although I have seen lots of people use it, but it just doesn't add up to it doesn't stand up very well to analysis. There's equally a lot of people leaving. Older people are leaving Vancouver because they want to sell and take some equity out and use that money to retire. And they can't sell in Vancouver and buy in Vancouver. It doesn't help them at all. But they can sell in Vancouver and buy in Kelowna or someplace else, and then it does ensure that their retirement is financially secure. And I don't think it's a bad thing, especially if your kids are no longer in Vancouver. That's the big test. I mean, if the grandchildren are still in Vancouver, then older people are going to stay. But if the kids have moved on, and you can get $2 million for your house that was worth $300,000 15 years ago, seems like it's a pretty easy choice to make.
Well, you're not wrong. All my broadcast friends who've reached retirement age in the Vancouver area, they've all sold, and now they're working part-time for all these radio stations in the interior. I'm sure radio in the interior of British Columbia has never sounded better.
all that big city expertise.
Exactly. Do people, when they retire, though, do they have to look at things like medical care and so on? You may not get that out in a rural area.
Yeah. I mean, well, there's some pretty, like Kelowna is a pretty big, but of course Kelowna is one of the places that is under the new tax. So, I think some smaller places, you might have to drive further for the doctor's appointments and stuff like that. But I don't know, that extra $1.5 million in your bank account will pay for a lot of trips to Vancouver to get medical treatment. So I don't know. It's and I think the reduced stress of having all that financial burden relieved might actually improve your health, at least your mental health anyway, if not your physical health.
And, of course, a lot more impetus, I guess, to get out and hike and walk and do outdoor activities. Yeah,
I mean, we drove, we were in Vancouver recently, and we drove around the Horseshoe Bay down by the water there where the West Van homes are overlooking the ocean, and not the view back to Vancouver to the lights, but the view out to the Bowen Island and the ocean and stuff. Because a friend of mine has informed me that there's a whole bunch of houses for sale, and I wanted to see for myself, and sure enough there are. That's the good news. There's lots of places for sale. The bad news is the prices are still ridiculously high, but obviously with that many places for sale, maybe the prices will be coming down. But it is a special spot there. I mean, it's really, there's 3 or 4 ski hills within an hour's drive. There's the ocean right there. And as long as the Lionsgate Bridge isn't completely blocked at rush hour, you're still less than half an hour from downtown if you need to get there. So there's a lot of good things to like about it. But the cost of housing is still, even with this sort of slump, you could call it, or maybe a flattening out in prices, these prices are still way over the level that anybody can really afford. So they'd have to come down quite a bit before you get an influx of people going in there. How many Albertans own places that they're not using in West Van? I don't know. It'll be interesting to see, because that would be like 2% of $3 million or something like that. That's $60,000 a year. That's $5,000 a month. So I think even wealthy people don't like to swallow $5,000 a month tax. So maybe it'll have the impact that Vancouver will become affordable again. We can hope.
Hilliard, thank you so much for talking with us.
Nice to talk to you again.
My guest has been Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. You're going to be having an updated version of the book soon, aren't you?
Yes, we're coming out with a second edition. It's got all kinds of new material, especially on some of the surprising things I uncovered in my research about what led us to this point where Canada's been singled out as one of the most indebted countries in the world. And it'll be available in June as the second edition. So definitely be interesting reading.
Thanks again, Hilliard.
Thank you.
Hilliard's website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. Questions for the show or for Hilliard can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.